The almighty balance sheet. To me, this is the most important financial statement because there's so much insight that you can get into a business if you understand how to read one. And today, we're gonna do a full deep dive. Grab a cup of coffee because we got a lot to cover. Stick around till the end and I'll share my favorite reasons for why a balance sheet is so insightful. Be sure to download this infographic right here and this Excel file that I'll link in the comments below. Okay, so let's start with what exactly is a balance sheet. Well, like many things in finance and accounting, it actually is what it sounds like. It's when you take a sheet of paper and you balance it as such, and you do your best to make sure that, a balance sheet is more commonly referenced as a snapshot of a business. It allows you to understand your assets, liabilities, and owner's equity. All right, before we go any further, let's back up and explain what exactly these three terms mean. There's this famous equation called the accounting equation, which summarizes this beautifully. And if you're not familiar, go ahead and check out this video explaining what it means as we do a refresher. See, each business typically has items of economic value that it owns. Those items are called assets, and it can represent tangible stuff like cash or equipment or inventory, but it could also represent intangible stuff such as patents or other intellectual property. The general idea is that these assets made their way to the business from one of two ways. Either amounts that were contributed by the creditors of the business, which we call liabilities, or amounts that were contributed by the owners of the business, which we call owner's equity. So as you can see, assets must always equal the sum of liabilities and owner's equity. So a balance sheet in essence shows the net worth of a company and must always balance. By studying a balance sheet, you could understand all the items of economic value that a business has, as well as all the amounts that it owes to creditors and the owners of the business. You may be thinking that the best businesses have really high assets with very little liabilities and very high owner's equity. And while that can be true, there could be exceptions. See, sometimes a business may have higher liabilities, which can signal the idea that the owners of the business are borrowing from lenders rather than introducing new owners. That could be a great move as now there's a bigger slice of the pie and all the profits of the business for each owner of the business. Or maybe you have a low amount of assets, but that's because most of the assets are reinvested back into the business operations or paid out to the owners of the business. See, there are a lot of different variations for what a good or bad business can look like when you analyze a balance sheet. And when you know how to read a balance sheet, you can put together a lot of the pieces of that story on your own. Okay, let's go a little bit deeper to understand how to read a balance sheet and why it's so useful. First, a balance sheet shows all of the information on a business at a specific point in time, which means all of these balances right here, they're cumulative. Now, this is different from a profit and loss and a statement of cash flows, which shows instead the incremental activity for each period shown. So for that reason, the balance sheet may also be referred to as the statement of financial position, because it shows the position of a company at a specific point in time. But to be honest, I've never really heard of anyone ask for a statement of financial position. Sir, please forward us your statement of financial position. We greatly appreciate your adherence to this matter. Let's go back to the top of the balance sheet, starting with our assets. As we said, assets represent the items of economic value that the business owns or substantially controls. Assets can be summarized in a number of different ways, such as cash and cash equivalents, current assets, fixed assets, intangible assets, and more. Cash and cash equivalents represents the cash that a business holds, like amounts in a business checking account, while cash equivalents are the amounts that can really quickly be converted into cash, like treasury bills or money market funds. Current assets are assets that are expected to be consumed or converted into cash, generally in about a 12-month period or less. Most common items here are accounts receivable, which represents the amounts that customers owe you for goods or services that they purchase, or inventory, which represents amounts of merchandise or goods to be used to sell to customers. Prepaid expenses, which are amounts you already purchased, but you have yet to actually consume the benefits of what you bought. And then non-current assets are pretty much the opposite of current assets. These assets are ones that you expect to hold for 12 months or longer and can be included in what we call fixed assets. Fixed assets are assets that the business invests in with the expectation of consuming the benefit of these assets over a longer period of time. So common assets that are fixed assets can be office furniture or vehicles, buildings, land, laptop and computers. You may also hear these as referred to as property, plant, and equipment, which pretty much means the same thing. Because you're going to benefit from these assets over a longer term period, it's considered a fixed asset. And anytime you purchase a fixed asset, it's oftentimes referred to as a capital expenditure, or CapEx for short. Most fixed assets, though, need to be marked down as time progresses and you use these fixed assets. Think of a car. You may have heard the saying that you lose 20% of the value of a car as you drive it off the lot that you purchased it from. Man, I just bought this thing. The way we show the wear and tear of our fixed assets are through an account called depreciation. Fixed assets get depreciated, which is an expense that goes into the profit and loss and gets accumulated via an account called accumulated depreciation. Man, that was a really clever name to give. So your accumulated depreciation will actually show a negative amount, which when you net with your fixed assets amount here, you get your net asset value. We call negative accounts like these contra accounts. Contra accounts are accounts that reduce the value in the section that it's in. While we're on the topic of fixed assets, let's also talk about a very similar topic, and that is intangible assets. Intangible assets are similar to fixed assets in that they provide economic value over a longer time frame than a current asset. Only in this case, it's non-tangible. So examples can include patents or trademarks or goodwill. Remember, these are all items that the company can claim add economic value to the company. So they're an asset. And like fixed assets, these intangible assets, well, their value may go down over time. Only instead of depreciating these accounts, intangible assets get amortized. That's pretty much the same thing as depreciation, only it's a cooler word. All right, cool, I'll be right there. I'm just gonna amortize this real quick. And you can accumulate all of the amounts amortized in a contra account called accumulative amortization. That pretty much summarizes the first part of a balance sheet and the first section in the accounting equation. Now we got two more sections on the balance sheet, which are both on the other side of the accounting equation. But first, if you're still with me, how about balancing your finger on your mouse over that like button? There you go. Now ready? Hit the like button. All right, I knew you had it in you. Let's now do a deep dive into the next section of our balance sheet, liabilities. Like we spoke about earlier, liabilities represent amounts that you owe to the creditors of the business. So you owe money to a bank, liability. You owe money to employees for their salary, liability. You owe money to customers for their product that they purchased, it's a liability. Liabilities, like assets, can also be summarized into current or non-current liabilities. Pop quiz. If current assets are assets expected to be consumed or converted to cash within a 12-month period, then current liabilities, come on, you got this. That's right, they are amounts that you expect to pay within a 12-month period. So let's go through a few examples of current liabilities. First, we got accounts payable. These are amounts that you owe to vendors for goods or services that you purchased on credit. Now you could also have credit card balances, which are amounts that you owe to your bank. Then you could have a popular liability called deferred revenue. Deferred revenue is the amount of goods or services that you owe to your customer and haven't delivered yet. So fun fact, deferred revenue is actually the opposite of prepaid expenses, which we spoke about earlier. So when a business pays for goods or services that they have not yet consumed to another business, like a 12-month subscription to something, well, this first business over here is going to record a current asset on their balance sheet called prepaid expenses. This other business over here is going to record a current liability called deferred revenue. Now, just like a business can have current liabilities, it could also have non-current liabilities or long-term liabilities, like a loan that you agree to pay off over a 5-year period. Remember, the key to liabilities is that it represents an amount that you owe to the creditors of a business. So it's capped. You know exactly how much money you owe. Owner's equity, on the other hand, well, that's uncapped because there's no limit to what you may owe to an owner of the business. It all depends on the future performance of the business. Owner's equity, like we mentioned earlier, represents the amount that you owe to the owners of the business. The most common forms of owner's equity can be common stock or preferred stock or additional paid-in capital. These represent amounts that are put into the business by the owners of a company who may now have a claim on the profits and losses of the business. And they may also share responsibility ensuring that the creditors of the business get paid. It really depends on what exactly the investment terms are. But capital contributed into the business, well, that's not the only owner's equity account. Another really popular one is called retained earnings. This account is an accumulation of all of the prior profits or losses of the business that have not yet been paid out to the owners of the business. The more you have in profits, the higher the retained earnings balance until that gets paid out to the owners. If a dividend is declared, well, your retained earnings then will instead go down. Perfect. Okay. So now we're comfortable with what exactly a balance sheet is and each section of the balance sheet. Now, I'm telling you, if you already understand everything that we just covered, you are in such a great place for running a business or investing in a business or just going really far in your career with the knowledge that you now possess. And here are a few reasons why. First, the balance sheet gives you the most amount of information between all three financial statements. See, a profit and loss tells you about the performance of a business by summarizing your profits and losses. But that information is getting pushed into our retained earnings balance on our balance sheet. And the statement of cash flows, well, this is really just a report that shows the movements in your cash, and your cash gets reported on your balance sheet. So this is oftentimes presented using the indirect method, which for the most part just summarizes the net change in each of your balance sheet accounts. So as you can see, the balance sheet has a lot of information that you can find on the other two financial statements. But the real reason to me for why a balance sheet is so valuable is that it gives you context. Okay, pop quiz. You're reading the profit and loss of a company and learn that they generated $1 million in profits last period, as well as $1 million in cash flows. Amazing, right? Not so fast. What if I told you that the business had a crazy amount invested into it, like $1 billion? Well, that would mean that it would take 1,000 months of profit for the owners to recoup their $1 billion investment, which would be over 80 years. So as you can see, you could really only tell how well a business is doing by comparing the profits to the amounts contributed to the business, which we oftentimes refer to as return on equity. Now, those are just two reasons for why I believe that a balance sheet is the most important statement. But now I want to hear from you. What do you think? Do you think the balance sheet is the most important financial statement in a business? And what's your favorite reason? Let me know in the comments below, and I'll catch you next time.